welcome to everybody who's joining us for this very exciting webinar today. It's very soon into 2022, and we appreciate that many of you are already returning to work. And we do think this is one of the exciting trends to watch for 2022, which is greater involvement of pension funds, particularly African pension funds, in driving and designing what sustainable finance looks like for Africa. As Tigis mentioned, my name is Louise Gardner. I am the Africa and Working Groups Coordinator for the Sustainable Banking and Finance Network. SBFN was established in 2012 at the request of 10 regulators, financial sector regulators from 10 countries who were interested in developing national enabling frameworks for sustainable finance. SBFN is facilitated by IFC, through the ESG department, and in collaboration with many IFC programs and advisory services. We also work very closely with the World Bank Group and with the World Bank teams, and we are supported by the World Bank Group. Since 2012, SBFN has grown to represent 43 countries. In that time, we have mainly focused on the banking sector, and we've looked at environmental and social risk management, something often referred to as ESG or ESG integration in the work of banks. But as you will know, in the past decade, we've also seen expansion of ESG and responsible investing and sustainable finance to include all parts of the financial sector ecosystem. Consequently, our members, who are banking sector regulators, capital markets authorities, ministries of environment, banking associations, have collectively requested that SBFN expand its mandate to include regulators from other parts of the financial sector. And that is why we changed our name from the Sustainable Banking Network to the Sustainable Banking and Finance Network in September last year. And in October last year, we published our third comprehensive review of national sustainable finance initiatives across 43 markets. It is the most comprehensive assessment of these initiatives to date, and it includes many of the initiatives related to pension funds that are starting to emerge. One of the leading countries in that respect is South Africa, where the Financial Sector Conduct Authority has played a very important role in helping South Africa's pension sector to integrate ESG in line with new regulations. But now we are seeing that interest expand to other countries in Africa, and some of this work is supported by the World Bank Group through the Finance Competitiveness and Innovation practice. And so we are very pleased to be collaborating with that team and with the African Pension Supervisors Forum today to hear how the African Pension Supervisors Forum, established in 2019, is hoping to raise awareness about ESG, sustainable finance, climate, social issues, and the ways in which pension funds can respond. We're also very pleased to be featuring inputs from two leading South African pension funds in this respect, the Government Employees Pension Fund and the Eskom Pension and Provident Fund. And we'll be hearing from them during a panel session later in the webinar. But first, I have the pleasure of introducing Mr. Nzomo Mutuku, who will be providing us with an set of introductory remarks today to set the scene and give the vision for the role of the African Pension Supervisors Forum on this topic. And Mr. Mutuku is he's the CEO of the Retirement Benefits Authority in Kenya, and he is the interim chair of the African Pension Supervisors Forum. Over to you, Mr. Mutuku.
Thank you, Louise. Representatives from Sustainable Banking and Finance Network, from the IFC, the World Bank, from regulators across the world and in Africa in particular, panelists and speakers, good morning, good afternoon, good evening, wherever you may be. I'm happy to be here speaking to you from Nairobi. It is raining cats and dogs, which is very strange because January is supposed to be the driest month. So if there's any evidence of climate change, I think we are seeing it. But this is supposed to be a hot and dry month, but it's actually raining. As you have heard, the African Pension Supervisors Forum, we have been around since 2019. We are a forum trying to bring together pension supervisors across Africa that we can collaborate on a number of areas of common interest to pensions provision in Africa. We are still young. We have been able to have 2 annual meetings, one here in Nairobi, another one online last year when we had the COVID challenges. And we're hoping to have another one very soon in Kigali, subject, of course, to how the COVID issues will evolve, so that we can really gather more momentum at African Pension Supervisors Forum. So as you have heard, we represent body authorities across Africa. We did collaborate with the World Bank in the study they did to review the approach to incorporating ESG factors into decision-making by pension funds in Africa. This was particularly leveraging on work that we had seen the World Bank do in other areas such as Colombia, Thailand. Also the potential of using SPVs for pension schemes to invest in alternative investment. So we have worked on this for a while, and I think we are happy to hear later on from Fiona some of the key findings from that exercise. I think, as I've said, climate change has now become a financial problem, no longer just an environmental or social issue. It is really a financial problem, which we can no longer ignore. I think if we are not careful, the impacts will become irreversible. Therefore, we need to take action. The Intergovernmental Panel on Climate Change did report that the rise in global temperatures of 1.5%, of which 95% is coming from human activities. Some of these activities, of course, our own pension funds are culpable, either through the investments or other ways that they are operating. Most of this rise, of course, happened in the last 35 years. And this was also a period where we have seen huge growth in pension assets across the globe, and even here in Africa. So I think we have a responsibility together with other players to counter the impact of climate change, rising sea levels, the impact on coastlands, species loss and extinction, which again is very relevant for Africa. Issues of health, food security, water supply, human security, natural disasters. All of this is making people, particularly in Africa, extremely vulnerable. So pensions being part of the financial sector, we must be concerned because the impact that our investments could have on climate change and on our survival. Already, there are some estimates that pension funds by the end of the century could lose 2.4 trillion in value just from the impact of this climate change. But on the other hand, as pension funds, we can be catalysts for greening the financial system. And this can be achieved through regulation, through building regional champions, through sensitization, and through bringing on board the members of the scheme, who are the ultimate owners, of course, of the assets. So there's a need for us as pension fund regulators and also capital markets regulators to work together to build green financial frameworks. And that is where we need to have a regional approach, and that is where EPPF comes in, where to do things like regional taxonomy, regional green bonds, guidelines, regional trainings for regulators and pension funds, etc. I think sustainable energy sources and clean technology is one of the key areas that I think we as pension funds can participate. And we are seeing technologies at different stages of maturity, which require different types of financing vehicles. Pension funds are generally more interested in low-risk investments, which provide steady inflation-adjusted income stream. But I see green bonds can fall very well into this category by giving you a steady income stream while also protecting you against risks arising from climate change. So we are happy with what we call socially responsible investments universe that is emerging amongst institutional investors. But on the ground, when you look at pension fund asset allocation to sustainable investments, it's still pretty low, particularly here in Africa. This is partly due to lack of environmental policy support in many countries, barriers to investment, including lack of appropriate investment vehicles. Here in Kenya, we only have one green bond, which is trading in our securities exchange, so we don't have much options. Issues of market liquidity, scale issues, regulatory disincentives, lack of knowledge, and very importantly, lack of track record and expertise amongst pension funds in terms of assessing these investments and their associated risks. We have a big challenge where even when we are ready to invest in, green assets, we may not be able to know which assets are actually green. And that's where I think governments have a role to play and regulators have a role to play to ensure that attractive opportunities and instruments are available to pension funds and institutional investors. And I'm very happy that on this meeting we have regulators from other parts of the financial system, the banking system, the capital markets, and so on, and who will help us to be able to access some of these sustainable investors. But for us as pension regulators, we also have a role to play. In South Africa, of course, as you're going to hear, they've gone ahead and really put strong provisions in terms of sustainability of investments, their pension funds. But most African pension regulations don't have specific requirements. Here in Kenya, we have gone only as far as having governance guidelines, which require that the schemes ensure that they take into consideration economic, environmental, social, and governance matters in the activities of the scheme. They have also gone further to say that the scheme is encouraged, and not the word is encouraged, to adopt socially responsible investing by considering not just financial return, but also social and environmental benefits of investment for the members and the broader community. So that is what we have in Kenya. And I think most African countries are not even at that stage of encouragement. I think they are silent on the issue of social responsible investing, apart from South Africa, like I've said. So it's also important that as regulators, we ensure that schemes have requirements to disclose social responsible investing, and what mechanisms they put in place for monitoring to see how corporate citizen outcomes are actually being managed. So, ladies and gentlemen, as developing countries, and African countries in particular, we are at disproportionate exposure to the risk of climate change. First, because most of the severe changes are going to occur right here in Africa and other developing areas. And second, the cost of protecting the society from these impacts are very high, including the cost of transitioning industries to less carbon-intensive models. When we don't have sufficient energy, for example, it becomes a real challenge to say that we should transition from the little we have towards less carbon-intensive models when we are not even having adequate supply. So it is a real challenge. We are also directly and indirectly exposed to transition risks because we have quite a number of dependents in our economies on minerals, energy, mining, and so on, which if these are no longer going to be used in the global economy, the impact on our economy will also be quite severe. So when we see policy changes coming up in the developed countries, these will impact all countries that are on the supply chain, which intersect with those developed economies. So that is another risk. And of course, as pension schemes, we do have significant investment in those sectors, such as mining and energy and so on, and we shall certainly be impacted. So the capital markets have a big role to play in financing the path to a low carbon economy. An increasing number of investment owners are coming to appreciate the impact that climate change is likely to have on their medium to long-term investment. So many of our investments may not be aligned with what has been agreed in Paris and Glasgow and so on, and may suffer falls in value, also restricted access, capital and funding, higher funding costs. So in as much as these climate risks are becoming clearer at the level of country and industry, they lead for much more clarity of the positive and negative impacts on individual companies and the ability and efforts to make appropriate transition. The transparency by issuers on sustainability will enable investors to identify issuers with no impact, issuers making a committed transition to reduced impact, or those aligned with the Paris Glasgow Agreement goals. So transparency will indeed enable investors to make more informed decisions. It's for this reason that we as the RBA, the pension regulator in Kenya, we did become a member of the Task Force on Nature-Related Financial Disclosures, TNFD, sometime last year. And we are embracing and championing its goals for providing market-led framework for investors to report and act on nature-related risks, and eventually encourage a shift in global financial flows away from nature-negative outcomes towards nature-positive outcomes. And the reason we have gone for the TNFD as opposed to the climate task force is because we feel that the nature risks are more relevant to us in Africa than the narrower sort of climate risks. So we shall continue to encourage other regulators in the EPPF and around to also join the TNFD and other similar frameworks which are supporting better disclosure on the risks around nature. So I think to wind up, just to say that the high caliber of speakers that we have here, we're going to hear from the South African experience, we're going to hear from the World Bank study, we're going to hear from the pension schemes themselves. I'm certain that this webinar will be very enriching and will enable us to really take this discourse forward and inform us as we do. So thank you to all moderators, speakers, and panelists, and thank you to all the participants for taking the time to join us. I wish us fruitful deliberations and a successful webinar. Thank you.
Thank you so much, Mr. Mutuku. I think you have very correctly kind of set the larger vision for the role of pension funds. There's quite a lot of landscape in terms of sustainable finance to explore. There's the risk side, so the extent to which risks are identified through pension fund investing, but there are also significant opportunities. And I think what we've seen through engagements with pension funds and pension regulators over the past decade is that it does need to be a mix of risk and opportunity and looking towards the needs of beneficiaries. So how will beneficiaries be impacted in the future by these trends, and what can pension funds do to support a better outcome in that regard? So to also give some context and definitions around what we mean by sustainable finance in these discussions, we've seen that sustainable finance has emerged as a broader umbrella term for several key types of activities. The foundation of sustainable finance is environmental, social, and governance risk management. And this is something that was built into South African regulation in 2011. It's something that we see increasingly adopted by investors globally through the principles for responsible investing. And in the banking sector, it's something that the IFC promotes through its sustainability performance standards for banks to assess environmental, social, and governance risks of potential projects, and then to look at ways to improve the performance of those investments. That is the foundation. Then we see another pillar is the financing of sustainability. What are the opportunities? What impacts can be achieved through things like green, social, and sustainability bonds, through new sustainability-linked instruments, loans, and other types of investments, and also responsible investing portfolios that could be offered to pension funds. But there's quite a lot still to be learned in that landscape, and it's developing quickly. We've seen that transition finance is now also one of the very interesting topics. How do you finance the transition to a low carbon economy, as Mr. Mtuku mentioned? So somebody who can give us a little bit more of a flavor of what that looks like when you ask a pension fund sector to start to implement these types of standards is Olano Mokbela, who is the Divisional Executive for Retirement Funds at South Africa's Financial Sector Conduct Authority. And Olano comes a long journey on sustainable finance with the introduction of South Africa's updated Regulation 28 for the pension sector. IFC also had the pleasure of working with the then the Principal Officers Association, now it is BATSETA, the Council for Retirement Funds in South Africa, to develop guidance for the retirement sector in South Africa in 2012, and we've supported capacity building since then. And in 2020, we partnered with FCI to undertake a survey of the practices being adopted by South African pension funds. Olano, I invite you to share a bit more about the journey and the practicalities of introducing this type of regulation.
Sure. Thank you so much, Louise, and good morning, good evening, good afternoon to everyone. It's really a pleasure to be participating at such an important webinar as this one. And so I suppose mine is a relatively easier task compared to my other fellow colleagues, because I am just meant to take you through the journey we have gone through as South Africa. And I must say it's been quite an interesting, rewarding journey. Once you see something you strongly feel about, and I'm one of those people who, if I see plastic, I just cringe. And so you probably need, people who are passionate about, environmental, social and governance issues for them to be, your champions. So just to get into that journey, Louise has given a nice background in terms of the definitions, and as you'd be aware, there are a number of concepts floating around, like responsible investing, impact investing, sustainable finance, and I think she's right. I think the all-encompassing phrase tends to be sustainable financing, and in there you can have your ESG in the form of environmental, societal, or social and governance issues. And in our journey, what I've realized is very important is taking everyone along. So as you'd be aware, there are various stakeholders in this area. There is government, and I'll take you through what they have done in South Africa. There is the regulator, which is us. There's the industry itself, which by and large is the one should effectively be driving these issues. And ultimately, it's us, the citizens, how we behave, conduct ourselves, in our small and everyday lives. And so this is the message which sort of came out strongly, even in COP 26, that it is going to have to be a collaborative process. Everyone does have to play their part. So let me start with 2011, because that's the date when we introduced revisions to what we call Regulation 28. So Regulation 28 is essentially a prudential asset spreading instrument. It tells you which assets you can invest in and up to what level. And I must stress, it's maxima, it's not minima. So we had a big debate in South Africa in the recent months around prescribed assets. And I think I'll touch upon this in terms of whether should we be compelling retirement funds to invest in certain assets, for example, like bonds, which raises another interesting question. Should we be forcing funds to be investing in green bonds? And so I think that's an interesting discussion to have. We have taken an approach which enables funds to make the decision. And that's important because you don't want to be a scapegoat when something goes wrong by having prescribed that, this is where you will be investing your money. And of course, there are other reasons why prescription is practically and generally not the right way to go when it comes to, how best retirement funds should be investing. So coming back to Reg 28, the two important revisions we did in 2011. One was to require pension funds to have an investment policy statement. Secondly, we introduced a principle, and I must stress a principle, not a rule, which required trustees of retirement funds to consider ESG factors when they undertake investments. And it's important to stress that this is not meant to target certain assets. It's literally meant to look at every asset a retirement fund will be investing in. So there are funds who tend to think when we talk ESG, all it requires is for them to have, for example, 20% invested in green bonds as their portfolio, and that is done. That is not the case, and that should not be the case. We expect a retirement fund to literally screen every asset they invest in using ESG factors. And this is something I've been stressing quite a lot when we were engaging with our industry this side. So we were forward-looking. Regulation 28 was very forward-looking because, as you can see, as early as then, we had already envisaged that ESG factors are going to be very important. And indeed, they've become so important. And as you had seen also how COVID has brought forward, some of these issues. I think it's important to also stress that as much as climate change has become more of the flavor of the month, in Africa, one can't ignore social issues. And I suppose it's not even confined just to Africa. So issues around gender, pay, and inequality around that, issues around discrimination at work, issues around investing in hospitals in rural areas. Those are important social issues. And so the good thing about us having adopted a much more broader approach in the form of ESG is that then you are expected to look at all those factors in them and not necessarily only the environment or climate related issues. But of course, needless to say, if the planet does pack up, then all these things are literally pointless. So one can appreciate the need to pay more attention, arguably, on climate issues. So moving on to 2019, as the FSCA, we issued a guidance. And just to take a step back, so Reg 28 is an instrument promulgated by the Minister of Finance. So it's the National Treasury, it's government, which issues it. So in 2019, we stepped in as the regulator and said, we need to provide guidance to the industry in terms of how exactly they can give effect to the ESG principle in Reg 28. There was a debate, and I suppose it's still something to talk about, why a guidance and not a mandatory instrument like a regulation. And there's a good reason, and Louise has touched on some of those issues. This is a high-pace evolving area. And what the guidance helps you with is the ability to tweak it as you go along, vis-a-vis a regulation which can be quite rigid. I mean, just to give you an example, as I was saying, the last time we revised Reg 28 was in 2011. The second time we're revising it is in 2021. So you can see the gap in terms of, you know, the time it takes to change regulations vis-a-vis a guidance, which we can do. It doesn't have to go to Parliament. It doesn't have to be signed off by our principals who are our government. So that's the reason why we felt let's do a guidance and tweak it as we go along. And the guidance required three things in support of the principle in Reg 28. One, funds were required to indicate in the investment policy statement how they would approach ESG issues. Two, it required funds to report and find ways to disclose their ESG approach in their annual financial statements. And so with those requirements, we started guiding the industry in terms of what they should be thinking about. And it was very well received, because there's always the issue that if it's a guidance, then, you know, people will just disregard it and ignore it. And I'll touch on the survey, because the survey was quite interesting in showing how a more nuanced collaborative approach vis-a-vis always the hard stick can actually still get you to the right outcomes. And so we held roadshows with the industry just to take them through, you know, the guidance and explain to them our thinking. And that's very important if you are a regulator, because you really need to take along your industry. Some of the things you might think they are quite obvious in the writing, but until you have a discussion and a conversation, you realize how people can actually misread, misinterpret, misunderstand the same, you know, phrases and wording in a document. So it's important to hold roadshows. Then fast forward to 2020, our government played again another important role by issuing a paper called Financing Sustainable Economy in South Africa. And so that gives you a sense of the role of government. And as I started earlier, that this has to be a collaborative process. You need everyone to play their part, and because government sets the policy, it was quite encouraging and very much welcomed by everyone when we saw this paper from the National Treasury. So a lot of things hinge on the paper. Luckily, you know, even with our guidance, we were quite forward-looking. So a lot of the issues which the government paper had highlighted, we had already started addressing them. So, for example, one of the proposals from the paper was that regulators must consider issuing some guidance around sustainable financing. Two, they must see how best to train trustees, and I'll talk about that in my closing remarks. And thirdly, requirements, to have requirements in annual financial statements of retirement funds, disclosing, monitoring, and reporting on how, you know, the funds are approaching ESG issues. Of course, the paper did highlight some of the challenges which Mr. Mutuku had picked on. So the lack of investment vehicles, the lack of a track record when it comes to returns. And, you know, I always say there's always the first time. There's always the first time. So the fact that something is not there doesn't mean one cannot start. And so, you know, this is something quite important for people, entities, regulators who are entering this space, that, you know, there's always the first time. And so we are also grateful that, as much as we appreciate that we do have robust markets in South Africa, so we've got the JSE, this is an area which continuously evolves. And I must say, I must give credit to our markets that they have managed to at least bring forth, you know, a number of these instruments, which is something Mr. Mutuku had highlighted, which is a challenge in other countries. So we do have a robust industry, a robust market, and as a regulator, you want to also support that. And so just to conclude, in 2020, we also saw the industry coming up with a RIO guide, responsible investment and ownership. And this is important to highlight because this was initiated by the industry. And again, it supports the point that we have to collaborate in this process, and everyone has got a place, and everyone should really, make an effort to contribute. I see Louise on my screen, so I suppose she's subtly saying, Olano, you've run out of time. So let me conclude and say it's been a long journey for us, but it's a journey worth going through. And ESG issues are not going away anytime soon. So the sooner one embraces them, the better for everyone. So thank you so much.
Thank you so much, Olano, and it's painful to interrupt you because there's so much to cover in the South African journey. So I've shared links in the chat to things like the RIO guide developed by Batseta, the Council of Retirement Funds in South Africa, and I've shared the National Treasury technical paper on financing a sustainable economy, and a link to the FSCA survey of pension funds, which has some very interesting data. I think to introduce our next, so thank you so much, Olano, for these insights, because they pave the way for the practical research that Fiona is going to be sharing with us, which also relates to implementation in a very key way, which is the disclosure by pension funds in terms of their ESG implementation, which has been a journey for the South African funds. But then the reliance of that on ESG reporting or sustainability reporting by listed companies and by the rest of the market, which is so important. And we've seen the Task Force on Climate-Related Financial Disclosures, the TCFD, has had a huge impact on the financial sector, and with the result that financial institutions and investors would like to be able to assess their portfolios in terms of how exposed they are to climate risk. And now with more TCFD reporting by the market, that is becoming increasingly possible to connect real sector and pension and financial institution reporting. But there are other areas where South African pension funds, for instance, have been impacted in social dimensions, and we will hear from that from the panelists. But one very good example is the Steinhoff saga in 2017, where Steinhoff was a listed company which had major corporate governance failings, which led to massive losses for South African pension funds. And it was a wake-up call for the South African market in terms of who should have known, what should have been disclosed, were the signals there in reporting, was reporting adequate? So we're looking at a very practical market risk if ESG reporting isn't adequate. And we see it also coming up in social elements, things like the Marikana massacre in South Africa in 2012, where there were indications that micro-lending and other poor social practices might lead to that kind of a confrontation. So how do pension funds access that data, and how do they report themselves? So handing over to Fiona to run us through the data that they've collected on those practices in Africa. Over to you, Fiona.
Thank you very much, Louise. Let me just see if I can navigate the tech here, and check that you can see the screen with the slides. Can you see that okay, Louise?
Yes, coming through clear.
Great. Thank you. So thank you for the introduction from Nzomo and Olano, setting the scene for why this is an issue where pension funds, as Louise said, I think the sector has been to some extent lagging. I think the banking sector and the whole green finance development area. And the region, I think also we need some catching up to be done across the region with some of the other larger pension funds globally who've been really driving this agenda in some of their countries. So this is where the Supervisors Forum and Nzomo and colleagues decided to try and have a look at where we are with the pension funds across Africa. What's happening with sustainable finance in the region? Where are we trying to go? And therefore, what is the role that the FSA and the others across the region can play to help the sector and the financial markets in general get there and to get to our sustainable development goals. And as Nzoma mentioned, we've done some of these benchmarking for some other countries and some other regions. So this was always a useful starting point to see what are pension funds disclosing in their annual reports. And that's a good window to try and see what sustainable finance practices are really starting to be embedded into their investment, into their risk management. Obviously, not everything that's being done is being reported, but it's a good window to start with. And that's what we did for the pension funds across Africa as well. And why we think and why we've seen pension funds being particularly interesting is that they are, to some extent, the top of the food chain. We're going to use the species analogy in Nzoma. They very much are the main owners of the long-term capital in the markets in the region. And through that, they can really be the catalyst for change for the green financial system. In some countries, it's through regulation. I mentioned Colombia that we were working in. It was the regulator was really driving the change. But in other markets, it actually can be the pension funds themselves. We've seen this in Japan is a very good example, the big pension fund, the GEPF in Japan, the GEPF in South Africa as well. You guys have been very much champions of greening and social investment, and actually can push the regulators, can push the service providers, can push the listed companies to provide you with the information you need. I'm really pleased to see that the Pension Supervisors, the Forum, the network across the region working together. Given that many of the capital markets in the region are less developed and are still quite small or fledgling, it could be very helpful to work as a group, we think, across a regional approach. And very much learning from this journey of South Africa. It's very much a stepped approach, but maybe some steps can be leapfrogged because your colleagues have already taken some of these moves, for example. And some of the specific issues I think will be important for the region, things like the sort of the concept of transition, as well as sort of the pure green of renewable, how changing some of the, as Nzoma mentioned, some of the practices and some of the industries across the region is important. And also because the way the pension funds hold quite a lot of real assets, real estate, for example, what does sustainable finance mean for them versus listed companies when the capital markets are not as deep as in some other regions? So thinking about different types of assets can also, I think, be an important nuance for the region versus elsewhere. So what we did is look at the pension funds annual reports, some of the big funds in the region. Actually, you have a good starting point. You have a good bedrock in that quite a lot of the funds actually doing, and Nzoma mentioned the governance requirements in Kenya, South Africa, you're very leading in corporate governance. You had the King Code, for example, many years back. So there's actually quite a good bedrock to then build on. There's less on a little bit on the S, and then very much the G and the climate is new. But there is a bedrock of this ESG to really build on. But there are definitely some very big gaps, as we'll see, was the overriding picture. What we did is we took some of the big pension funds. This is very much the leaders, and we did the same when we did the international survey. So the big public pension funds, the civil service pension funds, some of the national security funds in the region, they're very much the leaders, because again, they can be then the inspiration and really the example setters for the rest of the market. So we just started with a selection just of some of the larger funds and some of the South African colleagues we have today who we know are very much leaders in this topic. And then we look at a sort of stylized checklist of what would a full range of everything you could possibly report on ESG look like, about the organization itself, about the governance, the strategy, how do you build this into the boards? What then are you doing specifically by asset class, really digging into how do you actually embed this in your equity selection, in your bond selection? What do you ask your fund managers to do? When you're a pension fund that actually outsources your investment, how do you build that into the mandate that you give to your fund managers? And then finally, specifically the climate disclosure, which is internationally the big thing that's coming this year. So not all funds will have all of that. And even if you look at the global leaders, not every fund has every tick in every box, but we think it's quite a good way to see where are we versus this stylized or idealized end of the journey of what you would be embedding and therefore reporting into your practices. And what we've seen is, as I say, the information about the organisation is quite good from the big pension funds, who they are, what their assets are, quite good reporting there. And the strategy, the governance is also quite good. How do we make our investment decisions? How do our boards have responsibility, etc. Once you start getting into how do you actually do that by asset class, there's a little less information. Similar, I would say, with the asset managers, what you are asking the asset managers to do. And the climate is very, very fledgling. A few funds doing a little bit of reporting on climate, but very little. So on my left is the overall fund, what we've seen across the region. And on the right, if you take out the South African funds, which have been, as Nzoma mentioned with the journey, doing this for longer, a little bit lower on average, but you can see there are some good points there of some of the leading funds in the region. This is just a quick comparison with some of the other regions. As you can say, it's not that everywhere else on the funds are doing everything. Where I think you can see the governance, the organisation, the African funds are pretty much up there. But when you start to look into the actual asset classes, some of the international leaders are quite well ahead. Likewise on what they're asking their managers to do, and certainly there's more development on the climate side. So I think that's the big area that the African funds are really lagging. This was just out of interest we did in Colombia. Again, they're very much lagging. They haven't really started on the climate side. So you're not alone in other regions as well, but that's the area I think the African funds are definitely lagging at the moment. So just a very kind of quick through of give you a picture of what we're sort of seeing. This is when we're asking the questions about, how do you explain what your fund is? What's its mission? Who are your members? All of the sort of history behind the funds. Pretty good, actually, as I say, quite a good basis of explanation of reporting to the members of the funds and publicly is quite good. It's not bad across the region. Some examples of good practice, the Botswana Fund, very clear about their mission, how they outline what they're doing, who their members are. The GEPF, we know your reports are great, very clear reports from the GEPF as well. So some examples for what sort of good practice of transparency would look like. Likewise, when you start to get into how do you define long term? What is your investment strategy? What do you do with your ownership and engagement? Again, pretty good on the South African side, I think, because of the history of corporate governance, a little bit more patchy across the rest of the region. And when it really comes to the investment beliefs, how do you really start to develop a strategy for sustainable finance? Again, the governance history means some of the South African funds are there. We're starting to see a little bit more work that needs to be done across the other funds in the region. Uganda actually is a good example. The NSSF, the big fund in Uganda, has very clear reporting on its engagement, for example, on its SDG, matching some of its holdings and engagement. So there's some good, very clear reporting out of the NSSF. And the Sentinel Fund in South Africa is another one that's very clear on its objectives and what it's trying to achieve through its sustainable finance. So again, there are some good practice examples across the region. When we start to get into the asset class, so when you look at equities, do you have a negative screening? Do you have a positive screening? Do you have a tilt? Or all of these questions about how you might start to embed ESG or sustainable factors. Again, there's very little at the moment reporting of that. When you start to get really into the details of the asset class, we're not seeing a lot of that yet around the region. Old Mutual is a good example of really quite detailed on what they do by different asset classes, how they really build in, whether it's active ownership and voting, whether it's different types of screening. They're very clear about what they do across their asset classes. So that's quite a good example. And then again, when it comes to what do you ask your fund managers to do? Now, of course, some of the funds in the region manage the funds themselves, but Some, like the South African funds, do quite a lot of outsourcing. And again, you can see for the South African funds, there is some of them starting to say to their fund managers, you have to have an ESG policy. What is your ESG policy? We want to see it before we will give you a mandate, and we want you to report back to us, the pension funds. So again, this concept of being the top of the food chain, the pension funds can drive change across the financial markets. Starting to see that happen a little bit in South Africa. Again, the other funds in the region lagging. Some of that I think is because it's internal management, but some I think more work to do in how you give a mandate to your investment managers. The Eskom, I think we'll hear from our Eskom colleagues, very clear. They do that in their mandates very clearly. Alexander Forbes, again, have a really good policy and explain very well about what they explain they have to do when they're managers or if they outsource anything themselves. And then finally, on the climate front, a lot of red here, as you can see, a lot of red across the board. We know, as Nzoma mentioned, the TNFD, the TCFD, the international standards, they're coming. The standards on sustainability reporting are going to be put together this year. And this is going to impact all of us. It's going to be a very big change. So we need to start looking ahead and thinking, how do we implement them in a way that's supportive of the markets in Africa, that acts as a hook to get investments in green opportunities, rather than a barrier or a hurdle. If we don't start looking at this and reporting, it's going to be difficult for international investors to come into the markets. So we're not there yet, but I think some thought and some guidance on that going forward will be very important. Sanlam is a good example of a fund that's done so. So that's where we are. Where do we go next? Certainly very happy. We will share these will go up shortly on the website. We'll share all of these reports. We're happy to do more deep dives into countries and across the region. Very happy to work with the Supervisors Forum to think about how can we start to put some guidance, as Alana mentioned, to start moving in this direction. What guidance do the funds need now to move forward? I think it'd be really helpful to provide some training to make some more regional leaders. So we can see the NSSF in Uganda, let's take as an example, doing some good reporting. How can we really support some of the big funds to be the champions? And some of the regional and industry associations will be very helpful to start on this journey, as we've seen in South Africa. Working with the securities regulators is also important. You can't ask the pension funds to report if the reported company, the companies they're investing in, don't give you the information. So thinking of this as two halves of the coin and working together with securities regulators is very important. And again, that's the lacking the information in the markets. We have to get the markets themselves reporting this information for the pension funds to be able to do so themselves. Doing some work across this policies. We are at the World Bank, very happy to work with our partners in the sector to really help champion this and to really help the local pension funds then be also a hook and a driver of good practice to bring other international investments and to drive the creation of the investment opportunities, as you mentioned, Olano and Zomo. If the pension funds are pushing and saying, we want green bonds, then more will be issued. So looking forward to following up, and over back to you again, Louise. Thank you.
Fantastic. Thank you, Fiona. And within the SBFN team, we will continue to appreciate the collaboration with the World Bank's Finance, Competitiveness and Innovation team. You do very good work. So Fiona, if you can also, if we have a chance in the chat, just share any links that you have to the work that you've presented, or any update on when that will be officially launched. Thank you so much. So now we go over to the pension fund view, and just to give you a sense of perspective, the estimated assets under management by pension funds in sub-Saharan Africa is around $350 billion. Of that, about $190 billion, almost 3 trillion rand, is accounted for by the South African retirement sector. And with an estimate of between 4,000 and 5,000 pension funds operating, and quite a lot of diverse approaches to adopting ESG and sustainable finance. But one of the things we've noticed that's come through very clearly is that when funds become proactive about the risk side, managing the ESG risk side, there's a natural organic move towards wanting offers or products from asset managers that embed both ESG risk management as well as these new opportunities in well-performing, stable green bonds, green social and sustainability linked instruments. So I'm very pleased to introduce the moderator for our panel, which will now look at the experiences of South African pension funds, the GEPF and EPPF. And she's Martine Valsin. She is the Global Manager for ESG Advisory, Knowledge and Learning at IFC. And this covers both the risk dimensions, applying IFC's own sustainability performance standards and corporate governance standards in IFC's investments, as well as overseeing advisory work. And before that, before joining IFC in 2019, she came from Canada's Public Sector Pension Investment Board, so she brings very strong experience there, where she held the role of Senior Director for Responsible Investment, inaugurating and leading the integration of ESG factors. And before joining PSP, she worked at the Toronto Stock Exchange for 15 years. So Martine, I'm going to hand over to you to introduce us to the public sector or the private sector facing part of this discussion and to introduce your panelists. Thank you.
Thank you, Louise. Good morning, good afternoon, and good evening to all of those in attendance. So I have the great privilege of moderating this panel discussion on how pension funds in Africa can implement and integrate ESG practices in their activities. First, let me introduce you to our esteemed panelists. I have the pleasure of welcoming Sifiso Sibiya, who is the Head of Investments at South Africa's Government Employees Pension Fund, or the GEPF. The GEPF is a defined pension fund with 1.4 million members. It is the largest in Africa, with assets under management of approximately $140 billion US. Sifiso is a graduate of the University of Witwatersrand. He is also a fellow of the Institute of Actuaries, and he has 13 years of experience in financial services, specializing in investment, financial risk management, and employee benefits. He was joined by Shafiq Abrahams, the Chief Executive and Principal Officer at Eskom Pension and Provident Fund, EPPF, since April of last year. Before that, he held the position of CFO in the same organization. He has also worked with Deloitte and the National Home Builders Registration Council. He's also a graduate of the University of Witwatersrand and is a chartered accountant qualified in South Africa. I'm very happy to be moderating the session based on my background, but also as the manager of the unit who hosts the Secretariat of SBFN. So, gentlemen, thank you for joining us today. And to kick off the discussion, I will invite each of you to make opening remarks by addressing the following questions. First, what are some of the high-level practices that your institution has adopted to implement the regulatory requirements for ESG in South Africa and to achieve positive environmental and social impacts? And second, what are the 3 tips that you could suggest to other African funds starting on this journey? I will start with Shafiq, and then we'll go to Sifiso.
Thank you, Martine. Maybe just some background to the EPPF. The EPPF is a regulated pension fund regulated by the FSCA, and like Alano indicated, back in 2011, the FSCA has issued guidelines and around how funds should incorporate ESG factors into their investment decision making. Now, as a spin-off of that, or outcome of that, the EPPF back in 2011 adopted this ESG principles, and what came out of there was an ESG policy which defined our approach to ESG matters, investment-related matters, how we would implement it at operational level in terms of allocation of mandates, as well as in terms of how do we engage listed entities on a corporate engagement basis to express our views around social ESG matters. But as a PRI signatory as well, and given the social conditions within the South African context, so as active owners, we've also reflected what could we do differently back in 2011, 12, around that area. And there's 2 areas we looked at. Was one, how could we use our asset allocations to drive socioeconomic transformation within our industry? And we adopted what we call the broad-based Black economic empowerment policies to inform our views of how to effect social change within our industry through our asset management program. As well as we created a developmental impact portfolio to see how could we use a certain amount of assets in our portfolio to deliver the economic returns, but also to start quantifying the social impact. And since then, we've gone through a journey. 2019, we reviewed both those policies with a view to start defining more stronger objectives on the impact policy, with a view to identifying what impact we want to make and implementing an impact reporting system to come out of there. As similarly on our transformation program, we've moved quite substantially in terms of achieving the transformation around asset management within the industry, within the South African landscape, to have a positive transformation outcome. And so there were many positive spin-offs that came off from the initial ESG guidelines issued by the FSCA. I think going forward, we still have challenges, and we will continue to talk about those challenges later on. But I think some critical tips for other pension funds is, one, there must be a willingness to embrace the challenge or the opportunity presented by the ESG landscape. So from a trustee or from an organizational philosophy and leadership perspective, it needs to be embraced from the leadership. And it needs to become a value system within the organization as well. Two, I think most probably even more critical is the membership understanding the importance of ESG matters and the sustainability to the fund and to their benefits. And lastly, I think we're able to collect good data and develop the data capabilities are critical for us to be able to enhance and mature our decision making going forward in this area.
Thank you, Shafiq. Sifiso, did you want to go next and address those questions as well?
Yes, thank you, Martine. So good morning, good afternoon, and good evening to everyone. So the GEPF is the Government Employees Pension Fund of South Africa, and it's governed or regulated by GEP law, Government Employees Pension Law. So the fund in its current format started at around 2005, where it became standalone entity independent from the government itself. And from an ESG or sustainability perspective, the first significant milestone reached was in 2007. And this is when a set of proxy voting principles and guidelines were developed by ourselves and the PIC, which is the Public Investment Corporation, which in essence is one of our key asset managers that implements our investment strategy. So following from that, in 2009, we then derived or created our responsible investment policy, or RI policy, which in essence is a policy that articulates how we integrate ESG factors in the investment decision-making process, both within the fund and in investee companies as well. So we are signatories to UNPRI and CRISA, which is the South African code, which is similar to the PRI. And the fund sustainability rating from the PRI is currently at A, which is at the most recent full financial year, which is 2020. This is the highest rating we've achieved since 2016, when we started being rated by the PRI. The ESG practice of the GEPF is guided by our RI policy, which I mentioned earlier on, which we also then updated in 2017. And it has essentially 4 pillars, which are critical. The first one, the first pillar speaks to investments, and that captures aspects such as internal reporting, ESG integration into the investment decision process, and the ESG data that is required or collected by ourselves from our asset manager, who then requires it from investee companies. The second pillar is engagement, and this talks to ESG rating performance from investee companies and the fund in total. It speaks to proxy voting and also investee company engagement. In this particular factor, we do get a significant part of our resourcing and assistance from our asset manager, the PIC. The third pillar is industry collaboration. So this speaks to knowledge sharing, research, and involvement in industry bodies. So as mentioned, the fund is in the UNPRI. It's a member of CRISA, and also as at the end of last year, we also participate and have representation in the Asset Owners Forum, which is under BATSETA here in South Africa. The fourth pillar is ESG reporting, and this speaks to benchmarking and feedback and sustainability reporting. And as reported in the survey, the fund, through its annual report, does articulate and put forward all ESG reporting for the particular financial year that is being reported on. So on a practical basis, sustainability is looked at from two angles, which is done by the ESG working group, which is consisted of ourselves, the GEPF, and the PIC. So from the first angle, which is the asset allocator view, the fund would then basically determine a sustainability targets and metrics that will be used in collaboration with the asset manager, the PIC. And then on the second aspect, the manager would then be involved in driving the ESG performance and driving sustainability and reporting that back to the fund, which then the fund oversees as well. So that's on the ESG journey. Then secondly, in terms of tips that can be shared, I'd say the first one is around having a policy. So it was mentioned earlier on, I think from 2011, that all retirement funds within South Africa are supposed to have an investment policy statement. So it could be advisable for a fund, either within the IPS or as a standalone policy, to articulate their views on ESG and have a policy with that to that regard. The second point there that I'd want to mention is around collaboration. So it would be easier to achieve a broad-based impact for ESG factors if funds coalesce into industry groups and drive ESG implementation. And then the third aspect is around involvement. So most funds, especially from a South African point of view, would have proxy voting policies through the investment managers. So this is me now thinking back to my investment or asset consulting days, that it was very rare during a report back session where either the investment consultant or the manager is asked to explain or discuss issues such as how was a particular vote implemented around an AGM for an investee company, or sustainability in general. So when pension fund trustees start getting or would start the process of driving ESG from that angle, where during the report back sessions or to the investment consultants in particular, asking the ESG questions, it would start driving the behavior. And getting back to the point I mentioned earlier on, it's easy to start this process if you have a policy which is articulated, because it does give you a leg to stand on when you start challenging the asset manager and on how the ESG, or from an ESG perspective, how the fund is performing. So yeah, that's our perspectives on those fronts. Thank you.
Thank you, Sifiso. And maybe a follow-up question for you, and then I'll ask as well Shafiq to weigh in, is, ESG covers a broad spectrum of issues. Climate change is certainly top of mind. We've heard Nzomo mentioning in his opening remarks that nature might be more important, a greater area of focus in Africa. Also, social issues, are often close to the heart of your beneficiaries. So, what are the top issues on the ESG spectrum that you're currently tackling at the fund level? If you so, do you want to get us started?
Okay,
Yes,
cool.
thank you.
I thought Shafiq was going to go start. Okay, cool. So in terms of issues which are top of mind at this stage, so in thinking about the current and recent developments, so at least from a South African point of view, there's been increasingly less finance being made available to high emitting companies or polluters, if I could use that in quotation marks. And I'd understand that it's understandable because capital in this instance is being used to and redirected to influence corporate behavior and reduce emissions. Also, this capital is being redirected to fund cleaner energy sources and projects. But however, the unintended consequence of that is with the current energy supply plateauing and even reducing as old sources become decommissioned. All of that in the context of cleaner energy sources also not being brought into line in a quick or sufficient pace, it does result in overall energy supply reducing. And obviously this results in higher prices, and the knock-on effects would be higher inflation, which is part of the story which is being experienced currently in more developed markets. So this issue is particularly more acute in developing markets as ourselves, wherein the current energy sources that we have, some of it being heavily carbonized, are actually not sufficient to fund all the developments which are required, or the energy needs or demands which countries need. So basically then the sustainability goals, particularly in forums such as COP26, would then have to bear that reality in mind in them being set. So essentially that's the green, that's the just transition concept there that we're talking to. And that's what is the fund is ourselves as a fund apply mostly in our investment decisions. So in as much as basically we ascribe to climate change and driving driving the climate change agenda through our investment strategy, it's also important to recognize our current dependence on fossil-based fuel sources of energy. So that's essentially what's at the top of our mind at this point, managing that tension. Thank you.
Thank you. Shafiq, do you want to share what's top of mind at your fund?
Yeah, thanks, Martin. Look at the EPPF. I think for top of mind, the social aspects in the ESG has been occupied a large part of our agenda. And particularly of concern with from the EPPF is our economic growth, our levels of unemployment, gender inequality, rural, urban disparities, etc., right? And so a lot of our work has been around how do you drive the social impacts in this aspect. So job creation is important, gender equality is important, social transformation is important around race inequality. But at the same time, when on the listed space, governance has played an important part for us in terms of understanding governance and managing that expectation around the listed companies. We've looked at with the opportunities presented within the energy space, and we've got some success stories in there. We looked at how can we then leverage our investment opportunities using our real assets portfolio, particularly in renewable energies, to be able to drive some of this the environmental factors with the objectives of generating economic returns, but also using it to stimulate growth, economic growth, creating jobs, and having positive social impact. I think where we are right now as a fund, and as we speak, we're in the discussion around this, is how do we elevate our active positions around climate and the environment. And so we now need to move beyond using the environmental or ESG screens to inform our decisions, but to start issuing active positions around how we view this, where we are going, and the change we want to drive. And as we speak right now, we're in that strategy formulation or the policy positioning for the fund. But we do believe it's now time to elevate our status, our active positioning on this one, on climate change. In the next few months, we'll soon be taking proposals forward on that.
Thank you, Shafiq. At this time, I would like to also invite Nzomo and Olano to join the panel. We have a great question from the chat, so I'll be looking for volunteers to answer that question. The question is from Tertia Singh. She is talking about, the top-down approach that some of the funds have been taking in terms of driving change in the market. And she's wondering whether this places a significant burden on fund trustees because, things are very dynamic. They're the best placed in order to address this very fluid market, particularly when fund trustees also have to balance the interests of their members. So again, it's a bit of a balance act. But from the point of view of the trustees, is there anyone who is willing to take up that question?
I'm happy to chip in, Martine, just as I sort of wrote in the notes that, yeah, I agree that the trustees need a lot of support to do this, absolutely. And there's been sort of good training programs internationally, and I think this is one of the things that we need to think of across the forum. How do we support our trustees? And I know CETA and others have done good work on this in South Africa. But and there's always a balance between delivering the promises and the pension benefits, but equally acknowledging that this is long-term risks that we have to start bringing in. But absolutely, the trustees are key, and we need to give them the support to take on that role.
Thank you, Fiona. Anyone wants to chime in as well? Olano?
Thanks, Martin. So yes, Fiona is right. I mean, if you ask the question, who are the asset owners or who's representing the asset owners, it is the trustees, right? And so it is inevitable to a large extent that the burden will fall on them. They are the ones who carry the fiduciary duty. They are the ones who have to make those difficult decisions. But yes, as Fiona was saying, the question then is whether are they well positioned to discharge on those duties, and this is where the training comes in. And so in South Africa, we are currently revising what we call the trustee toolkit to incorporate ESG knowledge in it. And so this is a toolkit which is freely available to trustees and actually mandatory for them to undertake after they've been appointed or elected as trustees. So yes, one has to balance, and part of it is indeed, providing trustees with the necessary training and knowledge to be able to discharge their fiduciary duties properly. Thanks, Martin.
Thank you. I see Sofito has this hand raised as well. You want to go ahead?
Yes, thanks, Martin. So just a comment from my side. I'd say the role of a trustee, I'd say, is ever evolving, particularly in this particular context, wherein on the one end, one has to be concerned about the benefits that members should be getting and are entitled to. But on the other end, the environment in which they would be getting those benefits is also increasingly becoming important, because having the benefits but not being able to enjoy them because of various factors, things being dysfunctional in a particular market or economy is also not helpful as well. So I think increasingly that second part will start to be gain more importance as well. As mentioned earlier on, I'd say possibly, this could come via some, let's say, obviously borrowing from my prior experience in investment consulting, it would be having or the discussions to have a policy in place would assist in driving or starting the discussions going and steering the investment strategy in achieving the second part of what I talked to earlier on. Thanks.
Thank you. I'm being mindful of the time. We just have a few minutes left, so maybe we can do a quick fire type of answer round table. So, if there was one call to action that you would like the pension sector to take on this topic, one action that you would recommend that would move things forward, what would that be? Can I start with Nzomo?
Yes, thank you. I think the call to action should actually come from the bottom, not from the top. One thing I've realized is that, as the speaker has just said, members themselves are increasingly concerned about the environment they're going to retire in, and whether the assets are being used to do harmful things and so on. Especially the younger generation, who are in Africa, they are the majority in pension scheme. So I think we need to give members opportunity to give us their views, because when we talk of trustees and so on, the trustees will have no choice if it is the members who are demanding that their money be invested in a certain way. So I think sometimes as as policymakers, as regulators, we don't involve the ultimate beneficiary. So maybe we need to find a way to bring the members on board so that their voice can be heard.
I like this suggestion very much. Shafiq, how about you?
Absolutely. In my view, I think, we've got enough analysis, we've got enough evidence. It's time to act. And I think the differences in acting now is going to call for synchronized collective action. We need more collaboration. We need more joining of the hands. We need more alignment to make this happen now. And in that process, I do think we'll create the momentum and the breakthroughs to get some traction going. So my call to action is it's a time for synchronized collective and collaborative effort now.
Thank you for that. And Sifiso, do you want to go next?
Thank you. So mine is more of a practical one that speaks to standardization. So, of ESG data points across the different industry providers, or actual ESG ratings for the same companies, because they tend to differ sometimes as well, probably related to the data points being different. So that would be my quick call to action there. Thank you.
Thank you. And Olano, did you want to weigh in as well on this question before we conclude?
Yeah, I could give it a best. So I think mine is more of an advice to the trustees, which is don't be scared to ask questions. I mean, you'll be amazed at asking even what you'd think are the most basic questions, how people would realize actually they haven't thought of something, right? So the issue around proxies and how they're being used is quite an important issue. So if you are invested in a company, you should be able to ask, why is the board not representative of the demographics, right? Why is it that we seem to be paying different salaries to different agendas for the same job? And so it starts by asking the question. And once you do that, then you start also changing the other side, because then they realize that, these things are not just going to be glossed over and ignored. So that would be my advice, Martin. Thank you.
Thank you so much. And I'd also like to see if Fiona maybe has one last piece of advice for the pension sector based on the research that you have completed recently.
I would love to let's find champions like Saki, like Safifo, that are in the region, that really we can. So when people globally think, who are the leaders in ESG? We mentioned GEPF in Japan, we think of CDP2. Let's have a couple of the African funds that are go-to at the front of people's minds as leaders in ESG. And that, I think, will really help drive capital to the continent, to the opportunities that are there.
I cannot agree more with that. We are out of time, but one thing maybe I wanted to say to conclude the panel discussion. First of all, I want to thank you, all of you, for your contribution. But surely it seems that, you know, we have we have to take a holistic view. There are many pieces, you know, to the puzzle, and everyone has to play their role, whether, you know, the beneficiaries. I really like the call to action as well, to the beneficiaries, to the regulators, to the companies in which we invest, and also through, you know, the pension funds practices. So it's a broad ecosystem, and we have different levers that we need to activate in order to achieve the results that we want. Louise, I will hand it out to you for the final closing remarks. And also, I see that there were a couple of links that were shared in the chat, so please take time to take a look at those links. Thank you.
Thank you so much, Martine, and thank you to everyone for your contributions. I'm very pleased that it was a practical and a very grounded discussion, and I'm hoping this will be a very useful resource for our networks and for your networks going forward. So as mentioned, this recording and the slides from Fiona and the World Bank team and other resources that we've shared in the chat, we'll share these in follow-up emails to this webinar. If you haven't done so already, please subscribe to our webinars. There's lots of interesting things coming up this year. And then a special thanks to the Financial Sector Conduct Authority in South Africa, who've been a long journey partner with IFC on this topic and have taught us more than anything else. And also to Batseta, the Council for Retirement Funds in South Africa, that helped us pull the panel together today, and have worked very closely with our Environmental, Social and Risk Management Program, the ESRM program within IFC. And together they've developed the Rio Guide tool, which we did share the link. And as Olana said, the big learning has been asking what may seem like stupid questions for many trustees is a very important process in taking back active ownership. And it's a very valuable feedback in the system, because if banks and asset managers don't hear the feedback from asset owners, they've got no incentive to develop these products and to offer, to put together the information. And many of them are ready and willing to do that. So it's very exciting to see pension funds provide more of that feedback loop in the system. So thank you all for joining today, and also to RBA from Kenya. We look forward to partnering with you more in the future. Thank you all.